Hi folks, and welcome to the second and last video on our question where I'm asking you now to do a statement of changes in equity. Now, in the previous video, we were tracking the number of common shares that we issued and the total amount of money or assets given, to create the shareholder increase in equity in the common share account. So if you remember, we calculated that 20,000 shares were issued during the month of January, and the total amount of common share equity that was created when those shares were issued was 260,500 during the month of January. So when we're doing our statement of changes in equity, again, it's just for a period, in our case for the month ended January 31st, we want to start with a zero balance in each of the equity accounts because, as you recall, we just started the company in January at the beginning of the year. So all of our equity accounts, of which we have two, common shares and retained earnings, all start off with a zero balance. So we have no equity until we look at the shares we issue, income we earned, and any dividends we declared, because these three items would impact our equity. So we know that during the month of January, based on our tracking, we have $260,500 in common share equity created. That doesn't affect retained earnings. So on its own, that increased our equity by that amount, $260,500. During the month of January, so I should put January here, I'll just put January here because we know it's 2014. In the month of January, we earned income of $165,000. We know this because in the question, they told us that the income summary had a credit balance. So when we look back at the entry that we did, right, if it had a credit balance, to close income summary and move that profit into retained earnings, we debit the income summary and credit retained earnings. So therefore, we can see that we increased our retained earnings by $165,000. So the income increases our equity by $165,000. Dividends were also declared in January. So again, I'll just make that January. And how much? $12,000. Now you'll remember in the journal entry, what we said was that some companies could use cash dividends to declare the dividend, or they could debit retained earnings directly. That was one of the tips we discussed from our text. Because the question didn't tell us, that's why they've put two accounts in here. Now, if you had used the cash dividend account, you would have to remember that on January the 15th, if you use that account, then you'd have to remember on the 31st of January to close it to retained earnings. So you would debit retained earnings and credit the cash dividend account. Remember, the cash dividend account has a normal debit balance. So to zero it out or close it, we need to credit it. And dividends declared do decrease retained earnings. So that's why here in either case, you will find that your dividends that you declared decrease retained earnings by $12,000, which decreases your total equity. So if we add the columns here, we can see that we have $260,000 in common shares at the end of January, retained earnings of $153,000, and total new equity created of $413,500. And these amounts would go into the equity section of our balance sheet at January 31st, 2014. So I hope this video has helped you to understand how to prepare the statement of changes in equity a little bit better and definitely focused on our question.